Hello, I'm Matt Pierce, Vice President and Senior Portfolio Manager at TrustBank Wealth Management. Welcome to this installment of Chart of the Month. At TrustBank, it is our fundamental belief that over time, the stock market reflects companies' ability to innovate, grow, and generate profits. Corporate profits, or the after-tax earnings that a company produces, are ultimately what investors benefit from as stockholders and are the primary reason some stocks outperform while others do not. In the short term, however, markets will fluctuate based on a wide range of factors, including news headlines, geopolitical risks, and shifts in investor sentiment, forces that cannot be predicted consistently. This is why we focus on long-term fundamentals, including corporate earnings, industry trends, and economic policy, to assess the market's potential to create wealth over time. Earnings provide more than a snapshot of profitability. They reveal a company's competitive advantages, management's ability to execute, and commitment to a clear strategy. For long-term investors, understanding the quality and sustainability of earnings is essential to distinguishing genuine value creation from temporary or accounting-driven results. This month, we revisit a familiar chart that breaks down the S&P 500's total return into its underlying components: earnings growth, dividend yield, and price multiples, which reflect the premium or discount investors assign based on forward-looking expectations. When forecasting future market returns, our baseline begins with expected earnings growth, recognizing that unanticipated events can and do influence investor sentiment and price multiples along the way. In the years following the COVID pandemic, market returns were driven largely by fluctuations in price multiples. Beginning in 2024, returns became more firmly grounded in earnings growth, with earnings accounting for roughly 1/3 of total return. That trend continued in 2025, with the S&P 500 delivering a total return of 17.9%, supported by earnings growth of more than 13%. Looking ahead to 2026, earnings expectations remain constructive, with the market forecasting approximately 15% growth, a key factor underlying our outlook for positive market returns in the year ahead. While earnings growth remains the primary driver of long-term returns, valuations also play an important role in shaping investor outcomes. Valuations are influenced by investor expectations and sentiment and can contribute to market volatility over shorter time horizons. That's why maintaining diversification and remaining aligned with a long-term financial plan are critical to managing risk while participating in market growth. At TrustBank, we have designed strategies to keep our clients well diversified across markets and asset classes. We believe thoughtful diversification is the key to managing risk and uncovering opportunity through all market cycles. If you would like to explore how this approach can support your goals, we'd love to connect with you.